For decades, Americans were taught a simple promise: work hard, save responsibly, and the system will reward you with stability, mobility, and a better life than the generation before you. That promise is quietly breaking. Not with a crash, not with sirens, but with paperwork, interest payments, and numbers so large they feel unreal. If you watch this video to the end, you will not just understand what is happening to the U.S. economy. You will see how the rules of the game are being rewritten, and how wealth, power, and opportunity are being reshuffled in ways most people never notice until it is too late. This is not about politics. This is about math, incentives, and a debt structure that is starting to dominate the future before it even arrives. Right now, the United States carries a national debt that has passed $38 trillion. In October 2025, it officially crossed the $38 trillion mark, adding roughly $1 trillion in just over 2 months. That pace is not historical noise. It is structural acceleration. At this level, debt is no longer a background statistic. It becomes a gravitational force, bending policy, distorting priorities, and quietly deciding who gets paid first. In practice, this means the government is no longer just funding services. It is increasingly funding yesterday, paying interest on promises made years ago. In fiscal year 2025 alone, the U.S. paid about $970 billion in interest on its debt. That is nearly $1 trillion just to service what already exists. This single line item now rivals or exceeds spending on national defense and is larger than Medicaid. For every dollar of federal revenue collected, roughly 19 cents went only to interest. Not schools, not infrastructure, not health care, just interest. This is not a temporary spike. Under current projections, interest costs are expected to keep rising, reaching levels that were once considered crisis territory for other nations. To understand why this matters, you have to step away from the abstract scale of trillions. Think in household terms. Based on current debt levels, the implied federal debt burden is roughly $229,000 per household. That is not a bill you receive in the mail, but it is a shadow obligation. It shows up in higher taxes, reduced services, inflation pressure, and fewer resources for future investment. It is the silent partner in every economic decision Washington makes. What makes this moment different from previous debt cycles is not just the size. It is the cost of carrying it. For years, low interest rates made large deficits feel manageable. Debt was cheap. Refinancing was easy. The system could roll obligations forward without much pain. That era is over. The average interest rate on marketable U.S. debt is now above 3.3%, and much of the debt issued in the past decade is being refinanced at much higher rates. This creates a compounding effect. Old cheap debt is being replaced with new expensive debt, and the interest bill grows even if spending does not. This is how a debt interest spiral begins. When interest costs grow faster than the economy, debt starts to feed on itself. Growth is no longer enough to outpace obligations. Each new dollar borrowed carries a heavier future cost. The government becomes less flexible. Policy choices narrow. Fiscal space shrinks. Over time, more of the budget is pre-committed before Congress even debates priorities. This is not theory. It is already happening. Interest is now one of the largest and fastest-growing federal expenses. Meanwhile, deficits remain elevated. For fiscal year 2025, the federal deficit was close to 6% of GDP. For fiscal year 2026, projections still show deficits well above historical norms, around 5 to 6% of GDP. In peacetime, with no world war, this is highly unusual. Historically, deficits at this level were reserved for major recessions or national emergencies. Now, They are normalized. This tells you something critical. The system is no longer designed around balance. It is designed around continuation. Here is where the American dream begins to feel the pressure. When a government must allocate nearly $1 trillion a year just to pay interest, it has fewer tools to invest in future productivity. Infrastructure upgrades get delayed. Education funding faces trade-offs. Research, technology, and long-term competitiveness become harder to prioritize. At the same time, higher government borrowing competes with private borrowers. This can push up interest rates across the economy. Mortgages, car loans, and business credit become more expensive. The cost of living rises, not because of one policy, but because the system is carrying more financial weight. This is how debt translates into daily life. It does not announce itself. It shows up as tighter budgets, higher monthly payments, and fewer opportunities for upward mobility. Younger generations feel it most. They enter an economy where asset prices were inflated by years of cheap money, but wages did not keep pace. They face higher borrowing costs to buy homes, while the public sector has less room to support housing, education, or relief. The latter still exists, but the rungs are farther apart. Credit rating agencies have already responded to this reality. In 2025, Moody's downgraded the U.S. sovereign credit rating, citing rising debt and persistent fiscal deficits. This was not symbolic. It reflects growing concern among global investors about long-term U.S. fiscal management. While U.S. Treasuries remain the world's primary safe asset, even small shifts in confidence can have large effects when debt is measured in tens of trillions. Higher perceived risk means higher interest demanded by investors. That feeds directly back into the interest spiral. The deeper issue is structural. Mandatory spending on programs like Social Security and Medicare continues to rise as the population ages. At the same time, political resistance to higher taxes remains strong. This creates a narrowing corridor of options. Cut benefits, raise taxes, inflate away part of the debt, or continue borrowing. Each path carries economic and social costs. None are painless. The longer adjustments are delayed, the more abrupt they may eventually become. This is where the word depression enters the conversation, not as a prediction, but as a risk framework. A modern fiscal crisis does not look like the Great Depression of the 1930s. It is more likely to arrive as a confidence shock. Weak Treasury auctions, a sudden drop in foreign demand for U.S. debt, a spike in yields that forces rapid budget tightening. In such a scenario, the economy does not slowly adjust. It reprices. Asset values shift. Credit conditions tighten. Growth slows sharply. The psychological effect can be as powerful as the financial one. At this scale, debt is no longer just a number. It is a strategic constraint. It shapes how aggressively the government can respond to recessions. It limits the ability to deploy large stimulus without triggering market backlash. It changes how investors view the long-term stability of U.S. finances. The American dream, in this context, is not destroyed in one dramatic moment. It is diluted. It becomes harder to access. It feels less reliable. What makes this particularly dangerous is invisibility. Most people do not feel national debt directly. There is no single bill. There is no single headline that captures the full effect. The system absorbs it gradually. But compounding works quietly. Every year of high deficits and rising interest costs increases the baseline burden for the next year. The future inherits a heavier starting point. The question is not whether the U.S. can carry high debt today. It clearly can. The real question is whether it can continue to expand debt faster than the economy indefinitely without a shift in expectations. History suggests that no country does this forever without adjustment. The adjustment can be controlled and gradual, or forced and abrupt. That difference is determined not by ideology, but by timing and credibility. In the next part, we will look deeper at how this debt structure reshapes power, wealth distribution, and long-term opportunity, and why the people who feel the pain first are rarely the ones who designed the system. We will also examine why inflation, even when it looks moderate, becomes a hidden tax on the middle class in a high-debt world. When debt reaches this scale, it stops being a neutral accounting entry and starts behaving like a transfer mechanism. It quietly moves resources from one group to another, from the future to the present, from taxpayers to bondholders, from productive investment to financial maintenance. Every interest payment is income for someone, but it is funded by the productive base of the economy. This means a growing share of national output is no longer used to build new capacity. It is used to service old promises. Over time, this changes who benefits from the system and who carries the weight of it. In 2025, with interest payments near $1 trillion, a significant portion of federal tax revenue effectively flowed to holders of U.S. Treasury securities. These include domestic institutions, pension funds, insurance companies, and foreign governments. The largest foreign holders remain Japan and China, together holding over $2 trillion in U.S. treasuries, though China's holdings have declined from their peak. This matters because interest payments are not abstract. They are real cash flows. They reward capital ownership. They favor those already positioned in financial assets. At the same time, inflation acts as a silent partner in the debt system. Moderate inflation reduces the real value of outstanding debt. For the government, this can feel like relief. But for households, inflation is a hidden tax. It erodes purchasing power. It raises the cost of essentials. It punishes cash savers. In a high-debt environment, there is constant temptation to tolerate slightly higher inflation, because it makes the debt easier to manage in real terms. The burden shifts quietly from the state to the consumer. This is one reason why many Americans feel poorer even when headline economic numbers look stable. Real wages for many workers have struggled to outpace cumulative inflation over the past several years. Housing costs, insurance, healthcare, and education have risen faster than general inflation. When debt pressures exist at the federal level, there is less fiscal room to directly offset these pressures. The result is a squeeze, not dramatic collapse, a slow tightening. The American dream becomes more expensive to access, while the tools to support access become more limited. Wealth inequality is amplified in this environment. Asset owners often benefit from inflation and financial flows. Those who own stocks, real estate, and bonds see nominal values rise. Those who rely primarily on wages face higher living costs and higher borrowing costs. The debt system, in effect, leans toward capital over labor. This is not a moral judgment. It is a mechanical outcome of how interest, inflation, and asset pricing interact. Over time, this mechanical outcome reshapes the social contract. There is also a geopolitical layer. The U.S. dollar remains the world's dominant reserve currency. This gives the United States extraordinary borrowing capacity. It allows deficits that would be unsustainable for most other countries. But reserve currency status is not a permanent law of nature. It is built on trust, liquidity, and confidence in long-term stability. When debt rises faster than output for long periods, questions eventually emerge. Not about collapse, but about marginal shifts. Small reallocations by global investors can move yields. Higher yields increase costs. The loop tightens. A modern fiscal crisis would likely not start with panic in the streets. It would start in bond markets, weak demand at treasury auctions, a need to offer higher yields to attract buyers, rising interest costs that force faster growth in deficits. At first, this looks technical. Then it becomes political. Budget choices become more constrained. Programs face sharper trade-offs. The narrative shifts from abundance to scarcity. Confidence is the first casualty. Growth follows. This is where the risk of a depression-style dynamic in modern form becomes relevant. Not breadlines, but balance sheet stress. Not bank runs in the classic sense, but credit contraction. Businesses pull back on investment. Consumers delay large purchases. Housing slows. Asset prices correct. Government response is limited by already high debt and inflation concerns. The economy can slide into a low-growth, high-debt trap. Not a single crash, but a prolonged period of underperformance. History offers uncomfortable parallels. Countries that carried heavy debt loads relative to growth often faced long periods of stagnation. Japan after the 1990s is a partial example, though with key differences. Southern European economies after the Euro crisis experienced versions of this dynamic. The lesson is not that collapse is guaranteed. The lesson is that high debt narrows the range of good outcomes. It reduces resilience. It makes shocks more damaging and recoveries slower. For individuals, this macro structure translates into micro-reality. Higher interest rates mean higher mortgage payments. Student loans become heavier burdens. Small businesses face higher financing costs. Government programs become harder to expand. Tax policy becomes more constrained. The sense that the system is working for you weakens, even if no single policy seems responsible. This is how trust erodes, not with a bang, but with accumulated friction. The American dream was always more than income. It was about predictability, the belief that effort today would reliably translate into stability tomorrow. High debt and rising interest costs introduce uncertainty into that equation. They make the future more conditional. They turn what was once a broad promise into a more selective outcome. Some still climb. Many find the slope steeper. In the next part, we will confront the core question most people are really asking, even if they do not phrase it this way. Who pays when the system finally has to adjust? Through taxes, through inflation, through benefit changes, or through growth sacrifices? And why the timing of that adjustment matters more than the ideology behind it. Every high-debt system eventually faces the same unavoidable question. Not whether adjustment will happen, but how it will happen, and who will absorb the cost. There are only a few real mechanisms available. Taxes can rise. Spending can be cut. Inflation can be tolerated to reduce the real burden of debt. Or growth can accelerate fast enough to outrun obligations. In reality, most adjustments use a combination of all four. The distribution of pain depends on timing, politics, and market pressure. Raising taxes sounds straightforward in theory. In practice, it is politically and economically complex. The U.S. tax base is already heavily concentrated. A large share of federal income taxes is paid by a relatively small percentage of high earners, pushing rates significantly higher risks, capital flight, lower investment, and slower growth. At the same time, broad-based tax increases hit the middle class directly, reducing disposable income in an already tight cost environment. Either way, higher taxes function as a drag on consumption and business activity, which can slow growth just when growth is most needed. Spending cuts carry their own risks. Much of federal spending is mandatory, tied to entitlement programs that support retirees, health care, and income security. Cutting these programs means real impacts on millions of households. Discretionary spending, which includes defense, infrastructure, and research, is a smaller portion of the budget. Cutting there may reduce future productivity and national capacity. This creates a paradox. The easiest areas to cut may be the very areas that support long-term growth. The harder areas to cut are the ones growing fastest. Inflation is often the least visible adjustment tool. By allowing prices to rise faster than wages and fixed payments, the real value of debt declines. This helps the borrower, in this case the federal government, but it hurts savers and wage earners. It is a quiet transfer from households to the state. Over time, this can undermine trust in money itself. If people come to expect persistent inflation, behavior changes, spending accelerates, saving patterns shift, long-term planning becomes harder, stability erodes even if headline growth looks acceptable. Growth is the cleanest solution in theory. If the economy expands faster than debt, the burden shrinks relative to output. The problem is that growth at the scale required is difficult to sustain. The U.S. would need long periods of productivity-driven expansion. That requires investment, innovation, labor force growth, and stable financial conditions. High debt and high interest costs make this harder, not easier. Capital that could fund innovation is partially diverted to debt service. Policy flexibility is reduced. The very conditions that support strong growth are weakened by the debt load itself. This creates what economists call a fiscal trap. The system needs growth to escape debt pressure, but debt pressure makes growth harder to achieve. Over time, the economy becomes more sensitive to shocks. A recession that would once have been manageable becomes more dangerous because the fiscal buffer is thinner. The response tools are constrained. Stimulus risks higher inflation and higher borrowing costs. Austerity risks deeper contraction. The margin for error shrinks. Who ultimately pays depends on when and how markets force the issue. If adjustment is gradual, the cost is spread over many years. Inflation runs a bit higher. Taxes creep up. Benefits grow more slowly. Living standards rise more slowly. The pain is real but muted. If adjustment is abrupt, triggered by a loss of confidence or a spike in yields, the cost is sharper. Rapid budget tightening. Asset price declines. Credit contraction. The shock is felt quickly and unevenly. Historically, the latter scenario is what turns fiscal stress into social stress. The American dream is particularly vulnerable in abrupt adjustment scenarios. Home ownership becomes harder when credit tightens. Business formation slows. Job security weakens. People become more risk-averse. Mobility declines. The system becomes more defensive and less opportunity-driven. Even those who remain employed feel poorer because asset values and confidence fall. The psychological shift can last longer than the financial one. This is where generational tension enters. Younger workers face a system where they are asked to fund obligations created decades earlier, while their own future benefits are less certain. Older generations depend on programs that younger generations increasingly doubt will be fully funded in their current form. This tension is not ideological, it is arithmetic. When demographics shift and debt rises, the intergenerational contract becomes strained. Trust becomes fragile. Politically, this environment encourages short-term thinking. Leaders are rewarded for avoiding immediate pain, even if that increases long-term cost. Borrowing becomes the path of least resistance. Each cycle pushes the adjustment further into the future. But compounding does not wait for elections. It keeps working in the background. By the time pressure becomes unavoidable, the required adjustment is larger. This is how slow problems become fast crises. None of this means collapse is inevitable. The U.S. still has enormous strengths. A large, diversified economy, deep capital markets, global financial centrality, high levels of innovation capacity. These factors buy time. They provide flexibility. But time is not the same as immunity. The longer debt grows faster than the economy, the more of that flexibility is consumed. Resilience is used up gradually, like a financial buffer being drawn down. In the next part, we will connect this macro reality to the emotional and cultural side of the American dream. Why people feel like they are running harder, but getting less. Why trust in institutions is eroding. And how a high-debt world changes not just numbers, but mindset. When people talk about the American dream, they are rarely talking about spreadsheets or fiscal ratios. They are talking about a feeling, the sense that the future is open, that effort compounds, that stability is achievable. High national debt does not just change budgets. It changes that feeling. It alters expectations. It reshapes what people believe is possible, even if they cannot articulate why. In a high-debt environment, the economy becomes more financialized. More value flows through markets, interest payments, and asset prices, and less through direct production and wage growth. This shifts how success is achieved. Instead of building slowly through income and savings, wealth becomes more dependent on asset ownership and timing. Those who already own assets benefit. Those who are trying to enter later face higher prices and higher borrowing costs. The dream does not disappear. It becomes more conditional, more sensitive to starting position. This is one reason why younger generations often feel that the rules changed. They are not imagining it. The structure of opportunity is different. Student debt burdens are higher. Housing affordability is lower relative to income. Health and insurance costs take a larger share of earnings. At the same time, the federal government has less fiscal space to offset these pressures. When debt service absorbs close to $1 trillion a year, there is less room for aggressive policy aimed at expanding access. The system becomes tighter, even when growth exists. Trust in institutions erodes in this environment. People sense that promises are harder to keep. Retirement security feels less certain. Public programs feel more fragile. Even when official statements remain confident, the lived experience tells a different story. This gap between narrative and reality is corrosive. It does not lead to immediate collapse. It leads to cynicism, to disengagement, to a belief that the system is optimized for someone else. Culturally, high-debt societies tend to drift toward short-term thinking. When the future feels financially crowded, people focus more on immediate survival and less on long-range planning. Saving becomes harder. Risk tolerance drops. Entrepreneurship slows. Family formation decisions change. These are not abstract trends. They show up in demographic data, in business formation rates, in housing patterns. Over time, the social fabric adjusts to a narrower sense of possibility. There is also a subtle psychological effect of living in a system where so much of national effort goes to maintaining the past. Interest payments are payments for yesterday's spending. They do not build new roads. They do not train new workers. They do not invent new technology. They keep the lights on for old obligations. When a growing share of national output is devoted to maintenance rather than creation, the economy can feel stuck, even if it is technically growing. This stagnation of spirit matters as much as stagnation of output. The American dream was historically powered by expansion. New land, new industries, new technologies. Each wave created space for upward mobility. High debt shifts the system toward preservation rather than expansion. The focus becomes sustaining commitments rather than opening new frontiers. This does not mean innovation stops. It means innovation must fight for capital and policy attention against a rising wall of obligations. That competition changes outcomes. At the personal level, people respond by becoming more defensive. They prioritize security over growth. They choose stable jobs over entrepreneurial risk. They delay major life decisions. These choices make sense individually. Collectively, they slow the economy's dynamism. The result is a feedback loop. Slower dynamism makes debt harder to manage. Harder debt management increases uncertainty. Increased uncertainty further reduces risk-taking. This is how a high debt economy can drift into a low expectation equilibrium. Not dramatic collapse. Not visible crisis. Just a slow recalibration of what people think is normal. Lower growth. Tighter margins. Higher stress. The dream becomes narrower. Not gone, but harder to reach and easier to lose. At this stage, the danger is not only economic, it is psychological. When a population believes that effort no longer reliably translates into progress, social cohesion weakens. People look for explanations. They look for someone to blame. Polarization increases. Policy debates become more emotional and less grounded in long-term trade-offs. The debt problem, which began as a technical issue, becomes a social and cultural fault line. In the final part, we will bring this together and confront the central question. Is this trajectory reversible? And if so, what would real correction look like? Not slogans, not ideology, but structural change, and what it would mean for the future of the American dream. Reversing a high debt trajectory is not about a single policy or a single political cycle. It is about changing the underlying balance between promises, resources, and growth. History shows that successful corrections share a few common traits. They are early rather than late. They are gradual rather than abrupt. And they are credible to markets and to the public. Credibility is the real currency here. Without it, even well-designed plans fail to change expectations. A credible path does not require immediate balance. It requires a believable signal that debt will grow more slowly than the economy over time. That means aligning long-term spending commitments with realistic revenue. It means reforming entitlement growth in ways that preserve core support while slowing unsustainable expansion. It means a tax structure that raises sufficient revenue without choking investment. And it means sustained investment in productivity, the only force that can expand the economic base without increasing the burden on each individual. This kind of adjustment is politically difficult precisely because its benefits are long-term, while its costs are immediate. Voters feel the restraint before they feel the stability. Markets, however, respond quickly to credible signals. Lower risk premiums, lower long-term yields, more room for private investment. These are invisible victories, but they compound. Over time, they create a different trajectory. One where interest costs stabilize, where fiscal space slowly reopens, where growth has room to breathe. If correction is delayed too long, the adjustment becomes harsher. Markets impose discipline instead of policymakers. Interest rates spike. Budget choices become reactive. The tone shifts from planning to crisis management. This is where the risk of a depression-style dynamic becomes more real, not necessarily in the form of mass unemployment overnight, but in prolonged stagnation, repeated shocks, and a loss of confidence that takes years to rebuild. The cost of delay is not linear, it is exponential. For the American dream, this distinction matters. In a controlled adjustment, the dream becomes more demanding but remains credible. The path is narrower, but still visible. In a forced adjustment, the dream becomes unstable. The rules change quickly. Asset values can fall, job security weakens, public support systems are strained, at the same time demand for them rises. This is when people feel that the system has turned against them, even if no single actor intended that outcome. There is also a strategic dimension. The United States competes in a world where other major economies are watching its fiscal path closely. Confidence in U.S. financial leadership is a pillar of global stability. If that confidence erodes, the consequences extend beyond interest rates. They affect trade, investment, and geopolitical influence. Fiscal credibility is not just domestic policy. It is a form of national power. The uncomfortable truth is that the American dream in the 21st century cannot look exactly like it did in the 20th. The demographic structure is different. The debt load is different. The global environment is different. The dream must be rebuilt on a new foundation, one that emphasizes productivity, skills, and adaptability more than leverage and asset inflation. One that restores the link between effort and outcome in a high-cost, high-debt world. This is where the real opportunity exists. High debt is a constraint, but it can also be a forcing function. It can push reform. It can clarify trade-offs. It can expose illusions that no longer work. If used wisely, the pressure of debt can drive a transition toward a more sustainable model. If ignored, it drives a transition toward stagnation and conflict. The direction is not automatic. It is chosen slowly through policy, culture, and expectations. The central message of this video is not fear. It is awareness. Debt at this scale is not just an economic variable. It is a structural force. It shapes opportunity. It shapes trust. It shapes the future before most people realize it. The American dream is not dead, but it is being renegotiated quietly through interest payments, deficits, and compounding obligations. Whether that renegotiation leads to renewal or decline depends on choices that are being made now, even if they do not feel dramatic today. If you understand this, you are already ahead of most people. You see that the real story is not about a single crisis headline. It is about a long arc, a slow shift in what the system can afford and what it can promise. The question is not whether change is coming. It is whether that change will be controlled or forced. That is the line between a future of constrained stability and a future of repeated shocks. And that line is drawn quietly in the numbers most people never look at.